Welcome to Illuminati Silver. We tell you the truth about silver. Today is Friday the 18th of June 2021, and we're addressing the issue as to one rather hidden reason why the US dollar is strengthening, thereby helping to cause gold and silver prices to crash. There are many reasons why the dollar is getting stronger, but one reason is often missed, not so much by analysts, but certainly by the general public at large. So let's take a look as to what this reason is. We must be mad. It's a Friday and this is now the third video of the day. But so much is happening, we really want to get this information out to you, and we're very much aware that not everyone looks at Bloomberg on a daily or hourly basis as we do. Now, earlier today, we produced two videos. The one this morning, which came out about lunchtime, that's GMT +1 lunchtime, morning gold and silver update, where we showed that gold and silver recovered just ever so slightly from yesterday's crash, which we covered in the video why gold and silver prices just crashed. And then later on today, about an hour ago, we produced gold and silver prices fall further even after yesterday's crash. Now, we wanted to highlight, because we didn't have time in those videos, because we do try to keep them as close to 10 to 12 minutes as we possibly can, not always succeeding, but we do our best. We wanted to point out why the US dollar is strengthening, or at least the underlying reasons why it's strengthening. Now, we all know it's history, particularly now, if you've seen the news or you've listened to our videos, that the Fed, FOMC, didn't raise rates on Wednesday. Neither did they cut their $120 billion a month bond buying program. But they did refer to the fact that they are considering releasing that bond buying program in the not too distant future. Now, they haven't specified a date, but we suspect it could be what technically is known as tapering, happening in the next few months. But the key thing that moved markets was the very hawkish statement that a large number, I think it was 11 going by memory, of the Fed officials suggesting that interest rates will actually go up at least twice in 2023, and some of them even suggesting they may go up before then, towards the latter end of 2022. Well, the effect of this has been, of course, a strengthening of the US dollar, which at the time the spot index was hovering marginally below, marginally above 90. Now today has gone above 92.25. We've seen equity markets fall back. Initially yesterday around just under 1%, but today falling back further. And gold and silver prices falling quite considerably, which is what is causing those of us on this channel some concern, and other members of Illuminati Silver some joy, because it means they can pick up gold and silver at cheaper prices once again. But what we're looking at today is to perhaps try and identify one or two of the reasons why the dollar is still rising. Even though the announcement was 2 days ago, even though we're not in the reality of rates going up today or next month or the month after or the month after or the month after. But it's what other countries are doing which is helping increase the value of the US dollar. And this article, which was published today at 1:22 p.m. GMT +1 on Bloomberg, ECB to give banks $83 billion capital relief with extension. And we want to read some of this to you because it really is important that we look at what is happening to the currency and some of the underlying reasons as to why. The European Central Bank said it will grant lenders about 70 billion euros of capital relief by extending a measure designed to help them keep supplying credit to the pandemic-struck economy. The ECB will allow lenders to continue to exclude deposits held at central banks when calculating their leverage ratio for 9 months until the end of March next year, according to a statement from the ECB on Friday. That's today. The measure boosts the ratio of the 39 banks who have used it by 0.7 percentage points on average. You see, central banks dictate that member banks have to place a certain level of deposits or capital with them. They're basically saying we're continuing with the relief that we introduced a little while ago beyond the date that we originally envisaged. And what this means, arguably, is greater lending ability for those banks without some of the strictures that are normally placed on them, thereby creating arguably more credit into the marketplace within the European environment. Bloomberg reported on Wednesday that the ECB was set to extend the relief. The exemption, which would otherwise expire on June the 27th, effectively makes banks look stronger and allows them to do more business with the existing financial reserves. Now, this is the important bit. The ECB's stance contrasts with that of some peers, notably in Switzerland and the United States, which allowed leverage ratio relief measures to expire this year. It highlights the euro area's stronger reliance on bank loans rather than capital markets as a source of corporate financing. The ECB and other authorities have given banks unprecedented regulatory relief during the pandemic to help them absorb losses and keep lending. And by now, many institutions have seen earnings rebound. Now, this is crucial because it's creating more credit within the overall market, which arguably, and we'll have a look, I haven't read this yet, but we'll have a look at the unintended consequences, but from our banking knowledge suggests that the euro pro rata as a result of this arguably should weaken against the US dollar, or thereby strengthening the US dollar, making it a little more attractive for inward investment. The reason we say arguably is because if by doing this, the ECB helps businesses within Europe to expand and grow faster than they are in the United States, then arguably again, the euro will rise in value. And this is why economics is never ever a definitive mathematical conclusion, because different factors come into play with different end scenarios. Now, unintended consequences. Still, the ECB said banks will have to tweak their math in order to maintain the resilience provided by the leverage ratio. The relief will only apply to central bank exposures that have built up since the end of 2019, shortly before the pandemic started. The leverage ratio relief has helped avoid unintended consequences from the ECB's pandemic bond buying program. Bond purchases by the ECB have put more money into the lenders' accounts at the central bank, which may end up making those lenders look more highly leveraged were they not exempted. Some European bank regulators are keen to avoid extending the leverage ratio relief beyond March. Bloomberg reported earlier this week, citing people familiar with the matter. The US Federal Reserve let its broader leverage ratio relief measures lapse at the end of March, while saying that it would consider modifying the metric. The leverage ratio is one of two key financial strength metrics for banks. Starting June 28th, banks will need to have a minimum level of 3%, although that figure will rise slightly for individual banks that tap the ECB's relief. Now, the relief would give a particular benefit to banks in France, Germany and the Netherlands, which tend to have more central bank deposits than those in Southern Europe. It's really important. It's very technical, and the ramifications are not abundantly clear because they can play out in a number of scenarios. Our assessment of this is a continuing strengthening of the US dollar against one of the key currencies in the basket against which the spot index is compared, and that's obviously the US dollar versus the euro. Thank you so much for listening. Please, if you liked what we've covered, give us a thumbs up, make a comment, but most certainly do not forget to subscribe and press the bell sign so you're notified of our videos as and when they are published. Thank you for your time today. Please enjoy the rest of your Friday, and we hope you'll join us in our weekly update, which will be published tomorrow. Disclaimer. Illuminati silver owners come from a background of banking, international wealth management and economics. Having now retired from these worlds, we are not qualified to give investment advice. Therefore, this and other productions must not be deemed to be giving such advice and merely represent the personal views of its owners.